Hello, I'm Richard Claywell. Welcome back to another episode of Litigation Speaks. Today we're going to talk to you about sales multiples, and it's the hidden trap within the business valuation community. The concept for doing this particular podcast today is I got an inquiry from an attorney where two people had valued a company and they both used sales to revenues. That's not correct. I got this from an attorney where she was working on a company that had been valued by two different individuals, and they used sales multiples, which is a revenue multiple. They're basically the same thing. And the inquiry from her was, is that the way you really value a company or not? The answer is really pretty simple. I can give it to you in a two-letter word. It's no. You should not be doing that. So we're going to talk about the sales multiple, how it works, and the deficiencies within those sales multiples, so that when you get them, you'll understand what's really happening with that. Okay, using a sales multiple seems really quick and easy. And it is. It's a shortcut method that leads to mistakes. A sales multiple, also known as a revenue multiple, compares companies, trying to find comparable companies to value them. So here's where we have a problem at the very get-go, is how do you determine, and I'm assuming we're going to be valuing closely held companies, how do you determine that your closely held company is comparable to my closely held company? What factors did you go through to make that determination? And what factors are out there that's used in the business valuation community that says, did you look at, here's a hit list of different items to determine if they are or they are not comparable, and did the expert go through that? So how do they determine if it was really comparable or not? It sounds really simple, lots of mistakes in doing this. And I want to talk to you about why you should not use the sales revenue, or why it's not recommended to use the sales revenue. When you look at the total revenues of a company, you look at the sales or the revenues, whichever one you want to call it, but it doesn't look at the profits that the company has. Now, a little bit later on, I want to talk about this in a little more detail, but I want to talk about it now. This is my mindset whenever I value a company. Think about this. If you are going to buy a company, you as an attorney, you're going to buy a company. Are you interested in how much the revenues are that the company is making, or are you interested in the cash flow, the cash that you could put in your pocket? Which one is more meaningful to you? And it's going to be the cash you could put into your pocket. So the revenues does not get us to that particular point. Two companies may have the same or comparable revenues that are out there. One may be more profitable than the other company. So which company do you want to buy? Which company do you want to represent for your client? If you don't know what that profitability is, maybe you're misrepresenting the client. Maybe that the fact it's $1 million in sales and you've got $1,500,000 in expenses, the $1 million company sounds pretty good until you find out that we're actually operating at a loss of, say, $500,000. And these are just examples that I'm throwing out. So ignoring the profitability is a serious mistake and something that is not considered when you use the sales or revenue multiples to determine the value of a company. Every industry works differently. Some companies have high sales, low profits. Some companies have lower sales but higher profits. So now what industry are you in, and what is the appropriate comparable companies to be looking at to make that determination? If you get in a wrong slot, you're going to get a wrong answer. They are hard, very difficult to compare one company, one closely held company to another closely held company. There are just numerous factors beyond what we can talk about today on why those companies may or may not be comparable that are out there. The sales multiple does not take into consideration any of your operating costs. So when you have your daily expenses and those are not included in what you're purchasing, then it's going to give you a wrong answer for the particular value of a company. Each company has what's called capital needs. What type of equipment do they need to have? What sort of working capital do they need to have to pay the bills on a day-to-day basis? That is not included in the revenue or the sales multiple. So you're going to either overprice or underprice the value of a company if you wind up using the sales to revenue or revenue to sales multiple. It's affected by market trends, what's actually happening in the market. Unless you know what's happened over the last X number of years to that specific industry, and you can find a similar company that's out there, you're not going to know how that company is going to be impacted by a booming economy or recession. The information just doesn't tell you what that is. So now you have to try to figure out where you are in that particular industry. And I mentioned a while ago that the sales revenue multiple ignores cash flow, and it does. A single multiple that's out there is not going to tell you how much cash you can put in your pocket. When you use these revenue multiples, regardless of what you do, you're not going to be able to get to how much cash you're going to be able to put into your pocket. So because of that, we don't know how profitable a company is going to be. So when you're looking at the value of a company, you really want to look at the cash flows the company one generates versus the cash flow the company number two generates. You either want to look at the cash flows or the profitability of these different companies. When you look at the revenue multiples, people will say, well, my company is growing. Or they might say that my company has started to decline. And if you're working in a case where one party wants a high number and the other party wants a low number, then that's what you're going to get. Is my company's going to grow or my company's not going to grow? So the sales multiple or the revenue multiple does not give you that information. So how can you be looking at a company and you've got a client telling you, I've got a hockey stick projection that's going to go skyrocket, so the other guy should pay more for the company, and then the other guy saying, well, if you turn the hockey stick upside down, it goes down. That's really where I'm at. But these sales multiples do not tell you that information. We can go out and try to adjust that, but that gets really, really tricky, and it's real subjective because we really don't know what the answers are to that. When you have the sales multiples or the revenue multiples, you do not have any idea what the overall risks are to the business. We need to understand what those risks are. That will actually help us determine the value based upon a discounted cash flow methodology. So there are different levels of risk. We need to understand what those risks are and apply those risks. And again, in the revenue or the sales multiple, that information is just not provided. We don't know what that is. Multiples can be arbitrary. If we have increasing sales, what is causing that increase in sales? If we're having a decrease in sales, what is causing that decrease in sales? Are these companies similar? So if you're using a closely held company data, how do you determine if that data is reliable or not? So that poses a problem for us. The sales or revenue multiple is a quick and easy way to estimate the value of a company. There are a number of books out there that will give you the revenue multiples that are there. A lot of databases will give you what that multiple is, but it's fraught with errors. So be cautious if you use that. It leaves too many important details unanswered, so you just don't know what the answers are to a lot of these types of problems that you've got. A true business valuation, and not an estimate based upon just revenues or sales, needs to consider profit. And I mentioned a while ago, how much cash can a hypothetical buyer put in their pocket. And that's really what we're looking for. We need to look at the risk that the company has. What's the unique aspects of the industry? The revenues don't tell us that. For a more accurate fair market value for a company, I would suggest that you use a discounted cash flow methodology. That will give you a better picture of what the company truly is worth. So if you've got a case and someone has used the revenue or sales multiple to come up with the value, I would say it's problematic. Can it be used? Yes, it can. If you're going to use it, you have to have a really, really good reason for using that. And I can, thinking off the top of my head, I really can't think of any really good reasons to do that. But if you've got a really good reason, then it's something to consider. So if you have a case like this, if you have any questions about using the multiple of revenues or sales, feel free to send me an email or get in touch with me by phone or however you would like to do that. And I want to thank you for listening today. I want you to check the links below, see if there's any comments that you would like to make. If you do, send them to me. And I would appreciate the comments. I would appreciate your questions. This podcast came from an email, and actually I called the attorney back when I got her email about a discussion on a current case she's working on where both sides of the case are doing the price to sales multiple. So if we can help you, give us a call. Appreciate you watching. See you next time. Thank you.